Welcome to the deep dive. Okay, look, tax procedures. Maybe not the most thrilling topic usually, but super important, right?
Absolutely crucial. And things might be changing with the Kenya Finance Bill 2025.
Yeah, exactly. So today we're zeroing in, doing a real deep dive specifically into Part 7 of that bill. That's the bit that deals with tax procedures.
Right. Think of these procedures as like the operating system for taxes. Part 7 is looking at tweaking the main law, the Tax Procedures Act, Cap 469B. And these changes, well, they affect how taxes get collected, how the KRA works, and importantly, how you interact with them.
Okay, let's get into it. Our source for this is the official gazetted Kenya Finance Bill 2025. It's pretty dense stuff.
It definitely is.
So our mission here is to pull out the key nuggets, the really important proposed changes in Part 7. We want to give you clarity on what might be coming down the line without you needing to wade through the whole legal document yourself.
Precisely. We're focusing on the shifts that you'll likely notice most, the ones affecting taxpayers and the day-to-day running of the tax system.
Right. So, Part 7, where do we even start? There seems to be quite a bit in there.
Let's kick off with something very current, electronic tax invoices. The bill wants to amend Section 23A, basically to formally recognize and define these e-invoices.
Right? Invoices, yeah. Seeing those everywhere now. So what's the main change? Is it just making them official?
It's a bit more than that. It's about standardizing things.
Mm-hmm.
Interestingly, it also lists things that might not need this specific type of electronic invoice under subsection 3.
Oh, like what?
Well, things like salaries, emoluments, import costs, interest payments, certain accounting things for investment allowances, airline tickets, and also payments where withholding tax is the final tax. So it's not like every single payment needs this exact format.
Got it. So some carve-outs. And who's building this electronic system? KRA.
The bill gives the commissioner the power to set up and run an electronic system specifically for issuing and recording these invoices. So yeah, it points towards a central official digital platform.
Okay. And if I get one of these official e-invoices, what information has to be on it? Sounds like it needs to be pretty thorough.
Oh, it does. The proposal, subsection 2A, lays it out clearly. It must say tax invoice right at the
Right.
top. Needs the supplier's details, the buyer's details, name, address, PIN, a unique serial number, the date and time, exactly what was supplied, goods or services, quantity, type,
Wow, okay.
and any discounts, the cost, the tax rate, the total tax, plus anything else they might prescribe later.
Yeah.
It creates a really solid audit trail.
Yeah.
If you're running a business, your systems need to capture all this.
And this becomes the main document for tax purposes.
If you're a resident or a non-resident with a permanent setup here, and you're meant to use this system,
Yes.
yes, an invoice from the commissioner's system under subsection 1 is basically the record for sorting out your tax liability for that specific transaction. It really pushes people towards the official channel.
Makes sense. But what about the smaller players, small businesses, maybe farmers? Do they have to jump onto this complex electronic system straight away?
That's a key practical point. And yes, the bill includes an exemption. If you're a small business or a small-scale farmer and your annual turnover isn't more than 5 million shillings,
Okay.
then you don't have to issue invoices through this specific electronic system. You can use other methods. It seems like a nod to the fact that, adopting a full digital system can be tough for very small operations.
Right, that sounds reasonable. Okay, moving on. Amended assessments. Section 44 talks about changing assessments.
Yes, it amends Section 31 of the main act. This is about when the commissioner can revisit and change an original tax assessment they made or one you submitted yourself.
And are there time limits on that? How far back can they go?
The general proposal is this. For a self-assessment, the commissioner can amend it within 5 years after you filed your return. For any other kind of assessment, like one they issue to you, it's usually within 1 year after they sent you the notice. It's whichever date is later.
5 years or 1 year?
Yeah.
Okay, but are there exceptions?
Big ones. If they find evidence of, and the wording is specific, gross or willful neglect, evasion, or fraud
Oh.
by you or someone acting for you, then that time limit, it's gone. They can amend the assessment pretty much any time. And even in other cases, they still have up to 5 years to make further amendments, even if that initial 1-year window passed. So keeping good records is vital.
No kidding. And if they do amend my assessment, what do they have to tell me?
They need to notify you clearly. The notice should state the new amount assessed, any penalty, any interest charged, which tax period it relates to, the new payment deadline, and crucially, how you can object if you disagree.
Okay, good to know the process. Now, penalties. Section 45 mentions penalties for not deducting or withholding tax.
That's right. It amends Section 39A, Basically, it introduces a penalty if you're supposed to deduct or withhold tax when you pay someone, but you failed to do it, or failed to send it to KRA.
Seems straightforward. But hang on, what if the person I paid, maybe my supplier, actually went and paid that tax themselves later? Do I still get hit with the penalty and have to pay the tax I failed to withhold?
This is an interesting point in the proposal. It says you won't be required to pay the principal tax, the actual tax amount you didn't withhold, if the person who received the payment has already paid and accounted for that full principal tax.
Oh, okay. So it avoids double paying the same tax. That seems fair.
It seems aimed at preventing that, yes. Though penalties might still apply for the failure itself, just not the principal amount in that specific case.
Right. Got it. Next up, Section 46, security on property for unpaid tax. This sounds, well, significant.
It is. It amends Section 40. This lays out a process where if you haven't paid your tax by the due date, the commissioner can basically put a legal claim or hold on your property, like a lien.
How does that actually work in practice?
The commissioner can write to the relevant registrar, think land registrar of motor vehicles, telling them your property is subject to a security for the unpaid tax. The registrar then has to record this notice, usually without charging a fee. And once that's registered, it acts as a legal block, stopping you from selling or transferring that property.
So it secures the debt for KRA. Can they then sell my property?
They can. But first, once the tax is secured, maybe you offer another form of security or pay up. The commissioner can write to the registrar again to cancel the notice. However, the proposal also states that the commissioner can, after giving you proper notice, actually dispose of, meaning sell the property that's under restraint to recover the tax owed.
Wow. Okay. And what counts as property here? Just land? And who is this registrar?
Property is defined pretty broadly. It includes land, buildings, aircraft, ships, cars, or really any other asset the commissioner thinks is enough security for the tax debt. And registrar covers various officials: land registrar, registrar of ships, aircraft, motor vehicles, and basically anyone else legally allowed to register a property security for unpaid taxes.
Okay, clear. Let's shift gears slightly. Section 47, power to collect tax from someone owing money to a taxpayer. What's this about?
This amends Section 42. It gives the commissioner the power to go directly to a third party. The law calls them an agent who owes you money or holds money for you or might owe you money in the future.
Wait, so if I owe taxes and my client owes me money for a job I did, KRA could tell my client to pay them instead of me?
That's essentially it, yes.
Right.
The commissioner can issue a notice to that agent, your client in this example, requiring them to pay the money they owe you directly to the commissioner, but only up to the amount of your outstanding tax debt.
That could get complicated. Are there situations where they can't do that?
The bill does say the commissioner shall not issue such a notice under certain conditions.
Yeah.
However, the specific details of those conditions, those exceptions, they aren't actually spelled out in the excerpts we're looking at here. You'd need the full text to see exactly what those limitations are.
Okay, fair enough. Something to watch out for. Next, Section 48, appointing VAT withholding agents.
Right. This amends Section 42A. The proposal allows the commissioner to appoint specific people or companies to act as VAT withholding agents.
What does that mean they have to do?
When these appointed agents buy taxable supplies from someone, they'd have to withhold 2% of the taxable value at the time they pay the supplier. And then they remit that 2% directly to the commissioner.
So another collection point, basically. The buyer helps collect the VAT. Does this apply to everything?
No, there are important exceptions. It wouldn't apply to supplies that are zero rated for VAT. Also, it seems large manufacturers are excluded, specifically registered manufacturers whose investment value was at least 2 billion shillings by the end of December 2024. And the commissioner can also revoke someone's appointment as an agent. Oh, and it also doesn't apply to supplies for official aid-funded projects.
Got it. And quickly, Section 49 mentions digital service tax agents.
Yes, briefly. It proposes amending Section 42B to allow the commissioner to appoint agents for collecting and remitting digital service tax as well. It just reflects the growing digital economy, you know.
Makes sense. Now, what if you paid too much tax? Section 50 talks about offsets or refunds.
Yes, amending Section 47. If you've overpaid tax, the proposal says you can apply to the commissioner. You have two options. Either ask for the overpayment to be offset against other taxes you owe, or ask for a straight refund.
Is there a deadline to apply?
Yes, and it's different depending on the tax. For income tax overpayments, you have 5 years from the date you overpay to apply. For other taxes, it's a much shorter window, only 12 months. So you need to be on the ball if you think you've overpaid something like VAT.
Right, 5 years for income tax, 1 year for others, and what happens after I apply?
The commissioner is supposed to check your application, ascertain if there really was an overpayment, and determine the amount. If confirmed, they can then apply it to your other tax debts or refund the cash to you.
Okay, now, what if I disagree with the decision KRA makes? Objections, Section 51.
Yes, amending Section 51. This is a really crucial procedural point. The proposal makes it clear. If you want to dispute a tax decision, you must first lodge an objection directly with the commissioner.
Before going to court or anything.
Before proceeding under any other written law, yes. You have to file this objection within 30 days of being notified of the decision you disagree with. So it's a mandatory first step. The commissioner gets the first review.
Does it say what needs to be in the objection to make it valid?
The specific requirements aren't detailed in this excerpt, but typically you'd need to state clearly why you object and provide supporting info. The key thing is, once you lodge it properly, the commissioner has to consider it and make an objection decision.
Okay, deadlines. Section 52, due dates for submission and payment. Anything changing there?
A practical clarification, really, amending Section 77. It says if your tax return deadline or payment due date falls on a Saturday, Sunday, or a public holiday in Kenya,
Yeah.
then the due date effectively shifts. It becomes the previous working day.
The previous day, so not the next Monday, but the Friday before.
Exactly, the previous working day. So you need to plan ahead a bit.
Yeah.
If a deadline falls on a weekend, it's meant to avoid confusion, I think.
Huh. Okay. But is there an exception? I thought I saw something.
You did. There's an exception specifically for people submitting objections electronically or paying tax electronically. For those electronic transactions, the original due date, even if it's a Saturday, Sunday, or holiday, still applies, presumably because those systems are always on.
Right, that makes sense for online stuff. Okay, nearly there. Penalties ends, Section 53. This time for late filing or not filing returns.
Yes, amending Section 83. This section details the penalties if you submit your tax return late, or just fail to submit it at all. The proposal specifies different penalties for different types of returns.
Like income tax versus VAT.
Exactly. There are specific penalties laid out for late income tax returns, turnover tax returns, and VAT returns. It also mentions a penalty if you fail to submit some other required document, not a tax return, by its due date. It's all about encouraging timely compliance.
Are these fixed fines or based on the tax?
It seems to vary. For instance, income tax penalties might be a percentage of the tax due or a fixed amount, whichever is higher. VAT might be different. The bill aims to set out these structures clearly.
And Section 54 just clarifies penalties are separate.
Yeah, amending Section 89. It basically says each penalty under the different sections is calculated on its own. You don't just lump them together.
And finally, Section 55, failure to comply with notices.
Right, amending Section 109. This lists various things that count as an offense if you fail to follow official notices, requests for information, or other requirements under the Tax Procedures Act. Things like not providing documents when asked, not attending a meeting with the commissioner when required, stuff like that.
Okay, wow. That was a lot, but really useful. So to quickly recap, we've looked at the proposed changes in Part 7, covering electronic invoices becoming more formalized, the rules around amended assessments and those crucial time limits, penalties for not withholding tax, but with that interesting caveat about double payment.
The power to secure unpaid tax using property, collecting tax directly from people who owe taxpayers money, the new VAT withholding agent system at 2%, with its exceptions, the mention of digital service tax agents.
How to claim refunds or offsets for overpaid tax within specific timeframes, the absolute requirement to object to the commissioner first if you dispute a decision, the change to due dates falling on weekends or holidays moving to the previous working day unless you file electronically.
And updated penalties for late or missing returns and failing to comply with other official requests. It's quite a sweep of procedural adjustments.
It really is. And while maybe not as flashy as tax rate changes, these procedures, as you said, are the engine room. They directly affect how businesses and individuals deal with their tax obligations daily. Understanding these proposed changes is, well, it's essential to stay compliant and just navigate the whole system.
Definitely. Knowledge is power here.
Absolutely. So if you want to dig into the precise legal wording yourself, we really encourage you to download the full gazetted Kenya Finance Bill 2025. We've put a link right there in the description for you. Pay special attention to Part 7, obviously.
And maybe leave you with a final thought to chew on. As Kenya moves more towards these electronic systems, e-invoices, e-filing, potentially more digital interactions, How do you think this will actually reshape the whole taxpayer experience? Will it make things more efficient? Fairer? What role does having these clear procedures play in building trust between taxpayers and KRA? Something to consider.